Good morning, Jags. This is Fahad. Today is Tuesday, June 30th. A couple stocks on my watch list this morning. Let's start off with one of our favorite biotech, SGEN, Seattle Genetics. Seattle Genetics has pulled back just slightly, about $10 from its 52-week high, but this is a name that I've endorsed with the bull case multiple times in the podcast as well as in chat rooms recently, and I'm sure many of our clients are already long. I believe that this tiny short-term consolidation, perhaps between 160 and 170, is going to get resolved with more upside to come. And watch how the stock reacts today, given the news that came out yesterday. So something to keep in mind. The stock is guided higher by about $3 in pre-market, even though Dow, Nasdaq, S&P, and Russell 2000 index futures are guided lower by about 0.25% to about 0.5%. So this thing is going to gap higher by about 1.5% to 2%. It's going to open is going to open around 167, and let's see if this thing can start to break out from this bull flag and make a run towards 175 and such. I bring this up because yesterday, or actually day before yesterday, after market close, the company reported, along with its partner, which goes by symbol GMAB, or GenMab ASADR. The company reported positive top-line results for the phase 2 Innova TV 204 trial for Cetuximab vedotin in the relapsed and refractory metastatic cervical cancer. Now, interesting part about this trial results is that the oral response rate was extremely impressive at 24%, which was well above the consensus view. And what's even more impressive is the duration of the response of only 8.3 months, which was significantly less than what the consensus was estimating. Now, these results achieves the best case scenario than any other street estimate before the results came out, and they demonstrated ORR that was nearly double than what the anticipated response rate was in these patients with the standard care of chemotherapy that is out there on the market right now. The standard care of chemotherapy has slightly better than 10% response rate. And these companies, the two partners together, reported 24% response rate. And as a result, as a single agent chemotherapy, they can have a potential to achieve a high rate of 13.9% when combined with other drugs. And as a result, I believe this seals the deal for the company. And I think you're going to see some more positive reaction to this stock when the analyst community gets a better read on this one. I think you're going to see more analysts come out with more price targets, as well as the overall just a general tone around the company. So the stock is going to gap higher by a couple dollars, and I think we're going to see this thing run back above 170 and possibly move to 175 to $180 per share. So keep an eye on this one going forward from here. And the second stock is TDOC, symbol TDOC. TDOC has also pulled back slightly, with overall market coming down from a high of 208, now at 187. So on a percentage basis, this is actually already down about 10% from its 52-week high. And if you look at the chart closely, a lot of the times when you have nice breakouts from the descending resistance like this one, usually that gets retested. And that may happen pretty soon, either today or tomorrow, if the market weakness continues. So on a move down to about $175 per share, I believe this will provide a very interesting entry again. So keep an alert on that. Also, if you look at the VOP resistance or support levels, I should say, the VOP support levels also come in around $175 to $180 per share. Stock closed at 187 yesterday. Now, I bring this up because if you go to first read, today's first read that went out, here's an interesting note from Piper survey that came out today for the telemedicine utilization, and it catches my attention. Piper Sandler analyst Sean Weiland is saying that his checks are showing a survey of 525 consumer points to a greater than 10 times increase in annualized utilization for telemedicine in the second quarter versus Teledoc's prior 9-quarter average. 10 times higher utilization than the last 9-quarter average. That's a very, very strong read for the second quarter, which will be reported sometime by the end of July. 28% of consumers surveyed indicated having used telemedicine at least once in the last 3 months, which would imply 112% annualized utilization rate versus 9.5% only that the company has averaged among the US paid members from the first quarter of 2018 to the first quarter of 2020. So once again, the 9-quarter period there. And then lastly, they say that the inflection point is transformational shift, quote, transformational shift. And so we know that this company is gradually becoming a very large player. Keep in mind that the market cap of Teladoc today is only $14 billion. But with a revenue base that has yet to reach about, just still well behind the $1 billion annual run rate. But keep in mind, this is the total addressable market size of the company is about $154 billion. So you can think of that way from this pure leader, how much room they still have to cover. And with these kind of strong channel checks that are coming out for the second quarter, I think we're going to see another monster quarter from the company with a beat and raise. So I welcome this pullback, and I would welcome a pullback down to 175 to be ideal. If it gets there, we're going to pull the trigger and get long some call options, and I will let you know what kind of a structure and such. So I'm watching Teladoc and I'm watching Seattle Genetics. Chronicle.
Hey, Fahad. I was going to talk about Teladoc too, but lots of interesting analyst action in this morning's first read. But just a couple other things in the news that caught my attention overnight. Firstly, several more high-profile companies have joined the Facebook advertising exodus in the last 24 hours, including Ford, Adidas, Reebok, Hewlett-Packard, and Microsoft. Again, this has implications for other avenues of ad spending. And secondly, Wells Fargo and JP Morgan have warned of upcoming dividend cuts in the next quarter as a result of the Federal Reserve's restrictions on the capital that banks can return to shareholders. Meanwhile, most of the other big banks have opted to maintain their dividends. This is not a major development in itself, but I still think the bigger disappointment to come will be higher than expected provisions for loan losses and extension of buyback pauses as we head into earnings season. Q2 is probably going to be a write-off, but I think the market is going to place importance on forward commentary on the back half of the year. Looking at Q3 and Q4 earnings estimates for regional and money center banks, it looks like consensus has been gradually revising EPS estimates higher going into earnings, not by much, but higher revisions nonetheless. My thinking here is that loan loss provisions coupled with buyback suspensions are likely to result in earnings downside. So there could be some meaningful disconnect here. Overall, I'm not too worried about the larger banks because I think they're still going to be supported by strong numbers from their fixed income segment. It's the regional banks that I'm most worried about, particularly those in the Northeast and South.
Yeah, and I had a very interesting conversation with one of my friends over the weekend, who's also a hedge fund trader. We frequently get in touch and just talk about markets and what he's seeing and what I'm seeing. And we started talking about banks, and I asked him. I said, I cannot find a single good reason to own any banks there. The more I think about it, not a single good reason, any of them. Number one, everybody has tightened their credit standards, and they had no choice. And when you tighten the credit standards, it's telling you that either you're trying to preserve your capital ratios or you're simply worried about your loan losses reserves going up dramatically. and you don't get a healthy flow of loan activity growth when you're tightening credit. So purely from an operational standpoint and from the top line revenue growth standpoint, that's not positive. Number two, the shock that the small and medium-sized businesses suffered in the second quarter, they're going to see a sharp increases in the loan loss reserves across the board, particularly in the regional banks and the money center banks that do not have other divisions such as the trading volumes where they could benefit in the equity markets, or or benefit from any kind of bond issuance and such. Basically, the underwriting business, and a lot of the regional banks don't have those kind of business. They don't have exposure to any of those. So they're simply, classic traditional money center banks. So they're all going to post major increases in loan loss reserves. That's not positive. You're going to see that line hit their income statement. Number three, the net interest margins. And if you know of the 10-year bond yield, what it was doing in the first quarter of 2020, when it was average about 1.2%, but it was on its way down in March. And then in the June quarter, we saw basically the 10-year bond yield flatline essentially between 0.6 and 0.8%. So from a sequential basis, from Q1 to Q2, bond yields have been extremely depressed at the lowest records, near the lowest records in the U.S. history, and they're threatening to, break down below 0.6%. And that chart alone tells you that the net interest margins for all of these regional banks is going to be much, much lower sequentially, at least, and on a year-over-year basis, definitely. And so that's not positive for them. I can't find, so, and then, when you look at their book value as well, when you have loan loss reserves going up, the book value actually contracts and come down. A lot of the times these banks get valued based on what their book value is. I cannot find a single good reason why any of these banks would post a good quarter when the earnings season begins, particularly from the regional banks. All right, good stuff. Any more to add?
Nope.
Okay, good. As far as the Facebook is concerned, I will just say this. It was an impressive bounce, at least minimum to say, and I think it may have been mostly technical in nature because the first support actually came in around 204. The stock came down pretty much to that level and it started to bounce, but we'll see if this thing is going to fade again on this bounce. I don't expect the stock to go right back to new 52-week high because everybody is clearly watching that these numbers, advertising and spending numbers, are going to come down sharply with all these cuts that are taking place. Jay.
Hey, Pod. So two stocks. First one is Papa John's, who came out with a business update after the first read was published, so it was not included in there. Ultimately, CEO Rob Lynch said that in June, Papa John's delivered a third consecutive month of double-digit sales growth in North America and strong growth internationally. When you look at the press release, you will see that for the second quarter, system-wide North America restaurant sales are up 28%. And then for system-wide international restaurants, those are up 5.3%. So another strong showing, but I think that was, widely noted that was going to happen. What I would say though is that, and I can't remember which analyst it was, talking about how, Papa John's has not had to really come out with any innovation, any new menu innovation, even though they do have it in their back pocket, just because COVID has helped sales tremendously. So just continue to look for new menu innovation, over the next couple months, see what happens there.
Yeah. Very well said. And the high 20s growth, it's so impressive compared to what this company was doing a quarter ago or 2 quarters ago. But you're right, this is now pretty well understood by the street because the company has been pretty good and forefront in coming and providing these monthly updates to analyst community. So I think numbers have been gradually adjusted higher throughout in the second quarter. So the only risk here is that maybe when they will report earnings, nobody will find that surprising because everybody would know what the numbers are. Nevertheless, I think the stock, I think the stock is going to eventually set up with a breakout through $85 per share. It was trying it last week. It was looking very good. but the market pullback had this coming back down again. Nonetheless, I don't see downside risk in this one. I think it's gonna maybe just spend more time, consolidate, and then break out again.
And then the second stock is Helen of Troy. The ticker there is HELE.
Yeah.
The daily chart looks pretty good. And B of A, well, first off, I wrote about this in Behind the Numbers in the May 3rd weekend research. It was coming off a strong Q4 earnings, each of their segments up double digits. But this morning, B of A is out with a note. They raised their price target to, I believe, 205. Let me just double check that. Yeah, to 205 from 190. They raised their Q1 EPS estimates. They raised their full year EPS estimates. And what you're going to see, they report not this week, but next week, July 9th. And you're gonna, this past quarter obviously is going to cover the bulk of the pandemic. And I think last quarter on the conference call, management sort of set it up to where, I mean, they're setting a low bar. But what you're going to see probably is they're going to talk about the brick and mortar locations, how they were closed for some time, but you know, curbside was available, and then you started to reopen stores. But I think the standout will be their e-commerce, their online sales penetration, which they have been growing for the past 5 years. I mean, it started at about 6% and it's now at 24%. So you know, you look at some customers like Walmart, like Target, you know, who cited strong, you know, home growth. There Williams Sonoma as well. And, you know, even Oppenheimer recently was out with a note with channel checks, you know, saying that stores like that are showing strong growth in those categories. So just something to keep an eye on.
The company has two main divisions, the houseware segment as well as the health and home segment.
Mm-hmm.
And the latter, health and home segment, focuses on healthcare devices such as thermometers, humidifiers, blood pressure monitors, heating pads, filtration system, and such. Do you know the breakout of the revenues between these two segments? How big is the home and health? Because I would assume that's the part that is doing better in current environment.
Well, home and health, total sales wise, it's 44%.
Okay.
And then housewares is 33%. And so in terms of the home and health, you know, last quarter they talked about, you know, humidifiers and inhalants, air and water purifiers. They even talked about thermometers, how that can possibly represent sort of a new channel of development down the road. So yeah, I would expect strong numbers out of that category next week when we hear from them.
Sounds good. And I love this technical picture as a breakout play. And so we'll be watching this. I think if it breaks up from here, I think this thing is going to see a new 52-week high. So good stuff. Avo.
All right, good morning, everyone. Looking at Pinterest this morning, there was a good deal of August call buying yesterday, which possibly just targeting July 30th earnings. That's the data I have anyway at this time. But I think there's and also Fahad, on this one, you had refreshed your thoughts not too long ago. As a matter of fact, June 19th, there was some call buying in February 30 strike that you had spotted at the time. So I think it's possible that the advertising dollars that are being taken out of Facebook and Twitter, for whatever reason you might be given, are partly going into other places. I mean, even though advertisers are cutting costs, they're not just gonna stop advertising altogether. And I believe Pinterest being I don't think it's as political. If I don't use Pinterest, my wife uses it occasionally. She says she likes it. I just find it a little different from what I need, but it doesn't appear to be political motivations there. It's more a different setup, and I think advertising dollars are probably going to go there a little bit. As you noted in your update a couple of weeks ago, they have that the Shopify tie-in as well. So I think this is well worth keeping an eye on.
There were 19,000 volume in the August 21 calls yesterday, and the biggest block of that was 8,700. And that single block was bought to open for $2.60 when the bid and ask was $2.35, $2.60.
And the majority of that went in there.
Yeah, so that's a confirmation. These are opening bulls. So the open interest went from 996 yesterday to 13,000 this morning. So on a total dollar basis, arguably my rough take about $3 million worth of call premium was added in the August 21 call options yesterday. So definitely worth to keep an eye out. And the stock also had a pretty strong hammer reversal candle after pulling back nearly to the VOP support level, which is right at 20. And I think it may pause here in the short term, a day or two, and then before we see more upside. But definitely interesting one, so do me a favor, just keep an eye out on any kind of channel checks that would confirm the theory that that there have been some shift of advertising spend away from Facebook and Twitter into certain social media properties such as Pinterest that may be seeing actually that may be becoming beneficiary of those flows.
Yeah, if it's going to be based on recent advertising being pulled away from the other ones, it'll be probably a little too early to get anything. I checked if there was any recent or the latest updates, but there's nothing at this time in any case.
It may still be a week or two before you actually get any read through on that. The only thing I will say is that, as we discussed yesterday in the conversations, that I think that a lot of this advertising spend cuts that we're seeing were bound to happen anyway, given the slowing economy, and they found a perfect excuse with the racial, confrontation with Facebook to go ahead and just start cutting that expense line from the income statement across the board. Nevertheless, if they are simply shifting dollars from one platform to another, who knows, Pinterest actually could be beneficiary. And then aside from just the advertising logic, the previous bull case that we have laid out in Pinterest, which was just last week or 2 weeks ago in the chat room, was also about the improvement in platform, the download activity, and some other positives that we had around Pinterest that may be worth looking at. So these bets that we saw yesterday in the option market could simply be just betting on the organic growth that we highlighted that time. Good stuff. Keep an eye on this one, and who knows, we maybe see after a day or two, we probably see more follow through to the upside. All right, folks, that's it. We will see you in the chat room shortly.